Hi, I'm Manho. Welcome back to our margin financing series. In our previous episode, we explored why grade-based margin financing, or GBMF, is a smart way for investors to get more out of their portfolio. Here is a quick recap of the benefit. Lower interest costs. Leverage better rates and save on financing costs with high-quality securities. Flexible portfolio management. Enjoy the flexibility to mix and match different grades of securities, so you can optimize your borrowing costs and even use lower grade assets to acquire higher grades ones, building a stronger and more resilient investment portfolio at a lower cost. Transparent rates. With CGSI, you always know exactly what you are paying. Our floating rates are linked to publicly available reference rate, giving you full transparency and peace of mind. And if you are curious about the grade of your shares, it's easy to check the latest list of marginable securities anytime. If you missed that episode, make sure to give it a watch. Today, we are going to explore how collateralized value are derived in your margin trading account, and how does the collateral value affect margin ratios. Let's get started. Remember, in our first episode, we explored the different type of marginable collateral like cash and securities, and how your choice affects both your leverage and your buying power. The higher the collateral quality, the more you can borrow. Take note that if you pledge securities as collateral, your broker will apply something called a haircut. A haircut is simply a percentage reduction in the value of your securities based on their quality and risk. For example, top-tier, less risky securities like major index stocks get little or no haircut, meaning most of their value count as collateral. On the other hand, riskier or less liquid shares get a bigger haircut. So only part of their market value is considered as collateralized share value. To calculate your collateralized share value, we multiply the total number of shares by the valuation percentage after the haircut and the previous day closing prices. Let's walk through an example. Say you pledge $20,000 worth of ABC Limited shares, a top-tier stock with no applicable haircut, as collateral. And since you are using securities, you are eligible for a 4 times leverage, just like we discussed in episode 1. That means you can buy up to $80,000 in shares. Spotting a great market opportunities, you decide to buy $30,000 of XYZ Limited shares using margin financing. After the purchase, your total portfolio value rises to $50,000. To keep things safe for both you and your broker, you will need to maintain a minimum balance of equity in your margin account, also known as maintenance margin. How do we determine what is the maintenance margin? We use margin maintenance ratio. To figure out your actual margin maintenance ratio, we use this formula: collateralized share value divided loan amount times 100%. Based on the previous example, the margin maintenance ratio is at 167%. The minimum maintenance margin is put in place to ensure that there's always enough collateral backing your loan, minimizing risk in your margin account. We will cover how this is calculated in our next episode. Remember, each broker sets their own ratios. Here at CGSI, we are proud to be the first in Singapore to offer margin financing with a minimum margin maintenance ratio of 125%, which now gives you more flexibility and greater leverage to scale your trading activities. But what happens if the market turns against you and your XYZ Limited shares drop in value from $30,000 to $16,000? Now, your total collateralized share value is $36,000 and your loan amount is still $30,000. That will bring your financing ratio down to 120%. Since this fall below the minimum margin maintenance ratio of 125%, your broker will issue a margin call. So, what exactly is margin call? What are their options if you get one? And how is the minimum margin maintenance ratio calculated? We will explore this in our next episode.